This week's real estate and mortgage rate update, real quick. Let's jump in here. First things first, 30-year fixed rate mortgage, national average 6.78%. That has moved up a little bit from last week. Again, this is national average as of yesterday. 30-year VA and FHA both in the low sixes. So feels like we're trending in the right direction. However, I wanted to bring up what's been going on and why we're expecting it to be kind of choppy throughout this year. So let's see. So just to refresh your memory, this is the real-time trading feed of mortgage-backed securities. This is what impacts mortgage rates. Rates don't go up or down unless this goes up or down. Each of these bars represents a day of trading. They trade just like stocks do. Up and green is good for rates. Red and down is bad for rates. So first things first, back on March 12th, we had the CPI report, which is an inflationary report, and it showed that inflation was coming in cooler than expected, which in normal cases would benefit the bond market and we would see mortgage rates improve. But as you can see, we had a slight decline in mortgage-backed securities, which means that rates kind of ticked up a little bit. And the reason why is because despite the fact that inflation showed that it's cooling, there is this kind of backdrop of tariffs that the market doesn't know how that's going to impact inflation. Is that going to increase inflationary pressures going down the road? And so you've got this kind of timid market kind of being choppy. And then today, we actually, as you can see, this line drops beneath here into the negative territory. We actually started out the day negative after the Fed made their rate decision to hold. However, after their Q&A session, they talked about two future rate cuts. We started to see this improve. So that, and then they also talked about running off treasuries off the balance sheet. What that simply means is that through COVID, they were buying treasuries, kind of artificially keeping rates down. And then in October of 21, kind of when we started to see mortgage rates really start to take off, they stopped buying them, and then they were running off both treasuries and mortgage-backed securities off their balance sheets. So kind of like creating more supply in the marketplace than there was demand. And so that's why we've continued to see kind of a higher rate environment. So there is an expectation from the market after the Q&A today that they're going to slow the pace of that runoff, which will definitely help the bond market overall. And then the last thing that I wanted to touch on is just builder sentiment. The reason why I bring this up is simply because we're heading into the buying months, and there could then be some upward pressure if builders aren't building as much. Builder positive feeling, when we get these numbers over 50, that means builders are positive. That means they're engaged in, actively building. But when it's below 50, they're negative. And so you can see home builder sentiment overall is one of the lowest we've seen in a long time. It's been fairly low, but because, again, the unknowns around tariffs and materials cost as a result, there's an expectation that building costs could go up, which then translates into upward price pressure on homes. So again, when you start to take a look at high rate environment versus property price, home prices, we can always refi the cost of money. We can't refi the price of the home. So just wanted to give you some insight into what's going on in the marketplace. Stay tuned for next week.